Welcome back to the fifth lecture in efficient market hypothesis and portfolio analysis. Uh, Here we would be discussing about the approaches to portfolio construction. The various topics which we would be discussing over here is introduction to portfolio construction, strategic asset allocation, tactical asset allocation, dynamic asset allocation, core satellite approach, risk parity approach, factor-based investing, and the income versus growth portfolio construction. Okay, so these are some of the topics which we would be covering in the present lecture. So, introduction to portfolio construction. One important aspect you should understand over here is what do you mean by portfolio? First important thing is portfolio. Portfolio is number of shares can make a portfolio. So, which means share of Reliance plus share of Tata plus share of Infosys plus share of any other things. So, like that you have a pool of shares that can be called a portfolio. Second condition is it can be a combination of shares and bonds where I am trying to have some shares of either one company or more than one company plus certain fixed income bearing instruments, that is a part of bonds. So, it could be a combination of these two, or it could be a combination of bonds and bonds where I am not ready to take high risk. Okay. So, anything of this nature. So, any combination of this nature can be considered as portfolio, and I can very well have more than one portfolio in my overall investment strategy. So, when I am talking about portfolio construction, I am saying that I can have a portfolio of this alone, I can have a separate portfolio of this alone, and my risk gets minimized if suppose I have two portfolios constructed based on this platform. So, that is what you mean by portfolio construction. Okay. So, another important aspect which you have to consider while you are constructing a portfolio is the risk tolerance. So, what is the amount of risk you can manage? Say for example, I am a pensioner, okay, and being a pensioner, I may not be in a position to take a high risk based on number of shares. So, which means there is risk tolerance. I may go in for this category of investment, or I may go in for this category of investment. So, depending on the risk tolerance, I would be deciding how my portfolio should look like. Okay. And the second important criteria is the investment horizon. What is the actual time period when I am trying to do the investment? If it is in a situation where there is economic turmoil, then it is always better not to take high risk, because certain things are not in the hands of investors. So, what happens is it is better to take low risk, put it in bonds. When there is no such situation, investment is going in a smooth manner and everything is very good in as compared to an efficient market, then you can select any of these categories. So, investment horizon, the time period when you are trying to invest also matters. And what is your goal? I may be investing for a specific purpose, where I say that after 10 years, I want my child to be married. So, I know that 10 years is the time period which I am having. So, it is a long term period. So, probably equity investment can give me a better return than a bond investment. So, what is your goal is an important aspect, and based on these three aspects, you actually decide your portfolio as such. What type of instruments should be part of your basket? That is something which you can determine. So there are many other opportunities also which is available, which Dr. Anandita Chakravarti might have discussed in the first module, where she might have talked about the various investment instruments which is available. So you can have a combination of all those investment instruments as part of the portfolio whenever you are constructing it, and it all depends on the goal with which you are constructing the portfolio. So that's about the introduction to portfolio construction. Next is strategic asset allocation. When I'm talking about strategic asset allocation, it normally talks about what are the ingredients within a portfolio. So ingredients within a portfolio should include long-term asset allocation. Okay, so again we are going by the same criteria which EMH was telling, that it is informations get imbibed in the long run, and that is what is required. So if you are strategically identifying the asset to be invested in, you take long-term assets based on the risk tolerance, how much risk you can bear. That is the important aspect. So that's how strategic allocation is being done. And fixed proportion of different asset classes is also an important criteria, where I say that 20% of my share, if suppose I am a low risk taker, I say 20% of my money would be invested in shares, 40% in debt instruments or bonds, 10% in gold, 2% in crude oil. Like that I can divide, and remaining 18% in different categories based upon my risk tolerance level. So I have already determined the proportion in which the assets has to be selected and the money has to be distributed. So this is a very important role as investors you should understand, because constructing a portfolio is all about the expectation you have from the market and what are the best instruments available in the market, so that you can get a return based upon your expectation. There are, okay, I'll come to the other things also. Tactical asset allocation is you are adjusting the portfolio based on market conditions. So what I am trying to do is, if suppose the interest rate is increased for bonds and other things, might be out of the 10% which I told, the 20% which I am investing in share, I can shift 1 or 2% to bonds in excess, because I am risk averse. So I can invest in bonds excess of whatever I have decided. So that is tactical asset allocation, where you are consciously watching at the market, and based on the market condition, I try to determine what changes I have to bring in the portfolio, which can give me a better return. And this is going to work only in the short run. So tactical asset allocation is a strategy which you would be adopting in the short run, and it cannot be for a long-term purposes, because these market conditions could be for a short duration of time, for 1 year or less than 1 year. In that conditions you can use it, and you should always have a long-term calculation along with tactical asset allocation, where what is your strategic allocation, you know that, because this is for a long-term purpose, and you are trying to compare your strategic allocation with tactical allocation and seeing whether you are meeting out the goals in the long run. Take a short run may you get the benefit, but even in the long run it should be in alignment with the strategic allocation. There is another type of allocation when we are talking about portfolio construction, that is called dynamic asset allocation. So, dynamic asset allocation is nothing but portfolio revision at regular intervals of time. Portfolio revision at regular intervals of time based on market performance. So, this is somewhat similar to tactical allocation which we saw in the previous slide, but as the name suggests, dynamic, it is more frequent in nature. So, the time frame, based on the time frame, you can classify whether it is a tactical allocation or whether it is a dynamic allocation. So, the assets within your portfolio is changing at a faster period of time, you are revising it at a faster period of time based upon the market performance, and the risk factor involved over here is high, and you should have good risk management practices in picture, otherwise you may stand to lose out of the whole process. The next type of approach in portfolio construction is called the core satellite approach. So, core satellite approach is normally meant for long term investment, and that is why you find passive investors being part of the whole practice. And here the word core and satellite is nothing but, core is nothing but long term investors, satellite is nothing but the strategies which you have adopted to identify high growth opportunity assets. Okay. So, it is long term, at the same time you are talking about high growth assets. So, this is considered to be a better way of approaching whenever you construct a portfolio. I personally believe that this is the best approach which you can have, because you get a better return and you will be able to achieve your goal, but only challenge which you have is how do you balance the risk and return. So, it is important for us to understand and identify the different instruments which we are putting as part of the portfolio. So, you have more than one portfolio, so that you can take advantage of core satellite approach as well. The next type of approach is risk parity. So, as the name suggests, what does risk parity mean? It talks about balancing the portfolio based on risk, not on the amount you have invested. Okay. So, risk becomes an important factor, your capital is secondary over here. So, whenever I take a decision as to whether a particular stock has to be part of my portfolio or not, I will look at the historical prices and see how volatile the stock is, and based upon my risk bearing capacity, I would be deciding whether it should be part of my portfolio or not. Okay. So, I am not interested in seeing how much money I am going to put into that particular stock. I am interested in finding out what is the risk of that particular stock and whether I am ready to take that much risk while constructing the portfolio. That is the risk parity approach. And how do I diversify? I diversify it based on the various asset class having different risk contributions. So, knowingly, unknowingly, we have been doing the risk parity approach, whether it is tactical, whether it is the core satellite approach or the other approaches we have already discussed. Everywhere, somewhere or the other, knowingly, unknowingly, we have been using the risk parity approach. Okay. And the idea behind the risk parity approach is overall the risk of the portfolio should be less. So, if you have constructed more than one portfolio and if you can select only one portfolio out of it, you would be selecting the portfolio which has the least risk. Okay. So before I go into the factor based investing, let me actually discuss upon some of the important aspects which is related with portfolio management. So when I'm talking about portfolio management, what is the objective with which a portfolio is being managed? Okay, so the first objective you're talking about is safety. Is the stock which you have identified safe for me to put my money? Will my money be returned at least to the extent of how much ever I have invested? That is one important criteria, and that is where you are trying to look at the ratings by rating agencies and other things. So that talks about safety of the stock. Next is the stability of income. So stability of income says that whenever I select a particular stock, it should actually give me regular intervals return as and what I expect. Okay, so might be I select a share which is having a constant dividend policy, or identify a share which is having a constant growth policy in terms of dividend. So that is something which is required. So stability is a very important criteria. The third important objective is capital appreciation. So capital appreciation means the amount of money which I have invested should grow. Otherwise, there is no point in investing my money in these stocks. Next is marketability, means I should be able to sell as and when I like it. It's not that I can sell, I can also get cash out of it, which is called liquidity. And sixth is diversification. These are some of the objectives of portfolio management which has to be taken care of. And there are different approaches to portfolio construction. One of the approach is the traditional approach. So traditional approach basically talks about the financial statements and other things which shows a picture of growth and other things. Based on that, I take a decision. That is what you call as the traditional approach. And the next one what you have is the modern approach. So modern approach is something which is explained in Markowitz model, which we have already discussed in the earlier chapter. So these are the two approaches which portfolio construction is looking at in the long run. And apart from this, I would be interested in discussing the other aspects where I'm talking about factor-based investing, where I'm trying to look at the value of a particular stock, what is the direction in which the stock prices are moving, and in the long run, what return it would be giving. That talks about the quality of the stock in which I try to invest my money. And the next important thing is that how it is going to differ from the traditional market cap weightage. Okay, so if suppose I follow this approach, traditional approach, and I want to shift to a modern approach, what difference it is going to make in terms of my capping for different types of securities which I have discussed in the earlier slide. And this also talks about the benefits of diversification. Okay, so these are some of the important factors which is being considered. While there are certain phases of portfolio management. I'm discussing this because I think this is not part of the other chapter module. So I'm discussing this. So the phases of portfolio management, there are various phases. First phase, which we can say, is the security analysis. The second phase is portfolio analysis. The third phase is portfolio selection. And the fourth phase is portfolio revision. And the next one is portfolio evaluation. So let me just tell you in brief, we have already seen all these aspects, but still, security analysis, I have done fundamental analysis. I have tried to find out which company is good on various terms, based on industry, based on economic condition, all those, considering all those things, I did a company analysis. I have found out which security I have to put my money in. That is security analysis. So I may be investing in more than one company. So that becomes a part of my portfolio. So I have constructed more than one portfolio in which I have basket of instruments, investment instruments. It could be stocks, it could be bonds, it could be a combination of bonds, it could be a combination of shares. So any of these things. So you have a basket of portfolio. So I'm trying to analyze the different portfolio, and after analyzing the different portfolio, I select the best portfolio which I have constructed. Okay, so I select the best portfolio, I stay with it for some period of time, and if suppose there is a need for me to bring about any change in the portfolio, that is, I want to remove one stock and I want to include another stock because the performance of that particular security is not as per my expectation, I can go in for a portfolio revision, and finally I do the portfolio evaluation in the long run to find out what is the expected return I would be getting by means of investing in such shares or such stocks. So that is one important aspect which we have to look into when we are talking about portfolio construction. So here there are two types of portfolio we have constructed. One is income and the other one is growth based portfolio. So income oriented R is looking basically upon short term returns, that is dividends and interest. So dividends for shares, interest for the bonds and securities. Growth oriented, it is long term capital appreciation. So this talks about the wealth aspect. The other one talks about the short term aspect, dividends and other things. So depending upon the requirement, you would be deciding on which model you have to follow while constructing the portfolio. So in a nutshell, it is important for us to understand the various approaches we are going to take while constructing a portfolio. What should be the combination of various types of instruments within the portfolio. I have limited my discussion to bonds and shares, but as I told you, the different investment opportunities available has already been discussed in module 1. You can have a combination of any of the investment instrument depending upon your investment capability and the objective with which you are trying to invest. Accordingly, wait for a long period of time so that you get the actual return you deserve. Thank you.